Welcome to the third edition of PortfolioFocus. My name's Mathew Zschech. Today I'm here with Dr. Bewley from Woodhall Investment Research, and we're going to talk about, if I'm going to invest, how do I manage risk? You know, diversified portfolios, should I be chasing the last year's top performing asset class, or, you know, whether that be property or international markets or Australian? You know, really, with all the volatility we've seen, I mean, is the share market safe for investing? My superannuation, you know, what should I be asking my advisor in regards to managing risk? So thanks, Ron, for joining us here today. I mean, one of the things that we're hearing from clients is regarding diversification of portfolios. Where should they be investing? I mean, their superannuation, where is actually that being invested?
Well, it depends on the fund that they invest in. But really, there are separate asset classes like equities, domestic and foreign, and there's bonds and there's cash, and they all give you different rates of return, and the riskiest tend to give you the highest. Right. So if you put all of your money in the riskiest, which would be international equities, then there's more chance of falling over if something goes wrong. By balancing some international with some domestic equities, some bonds, some cash, in proper proportions, it's not guesswork, these things are worked out scientifically, you can balance the risks and returns so that you get the best risk-adjusted return. And that's the point. How do I get a risk-adjusted return that's good for me?
The analogies that I've used in the past in regards to investment portfolios is, I mean, I use a sporting analogy. I mean, I used to play cricket and rugby, and effectively it's, you know, your investment portfolio is a bit like a team. You know, not every member in that team is a star performer at any one time, and no one runs onto the field of play with one player. So if you're choosing property one year, and if you're choosing your star player of shares the next year, you know, Australian blue chip shares, or the next year you're choosing international equities, we really, you know, need our portfolios to operate as one. So what would you say in regards to, I mean, a client chasing one particular asset?
You do need a balanced approach. You do need the whole team working together. And it's the manager gets paid a lot of money in the football team because he knows which players go with others. Yep. And if you look at the top clubs like Manchester United, I think they just got rid of a player because he didn't fit with the team. He was a star player. Yes. They get another one in that fits. Does it have the right style? And the last thing you want to do, to go off the sporting analogy, is to chase the best asset class. I remember somebody giving a paper where if you started with 1 cent in, I think, 1980, and every day you went from bonds to equities and back, you'd finish up as a billionaire, and there aren't any billionaires around who've done that. You just can't win. You think you can by saying, I nearly did it, but are you getting the right prices? It takes time to switch, and there are big costs involved, not least of which is tax. Capital gains tax can destroy your investments by swapping too often. But I've never known anybody who can win, and if I can tell a personal story about my private client advice I was part of, there was a gentleman with a lot of money, a serious amount of money, who said he was great in equities, and we're talking about lots of zeros. And we tried to talk him into having just a small proportion for him to play with and the rest in a proper portfolio. And he said, but I'm winning, I'm doing so well, and he had all these stock picks. We had his records. He'd been losing hand over fist and didn't know it. So he was destroying his family wealth without understanding. And it's easy to get that illusion. Just ask anybody who comes home from the racetrack, a fun day out, did you win or lose? Break even means you lost a lot. And that's the way it would go if you try to do your own investment.
You were saying that the Australian market is a good investment, but the Australian market has fallen, you know, 20-odd% in the last year. There's a lot of debate at the moment about, you know, switching out of my share market investments and moving to gold, or switching out all of my money, you know, taking huge macro bets and moving all of their money into cash. I mean, is the share market still safe?
Again, there's two questions in there. If they're thinking about changing into cash now, it's actually too late because the market's already fallen. So if you wait till it's too late to do the change, that's how you lose money, by keep going from one asset to the other after it's fallen.
And you can, in saying that, you can be a perpetual mistimer. You can be selling out at the bottom of the market and then buy in at the top.
But there's nothing wrong with being in cash, as we've said before on these shows, that having the right amount of cash in your plan before you get there, that's fine. Different people need different amounts of cash. So how should we go off there? But is the share market safe? Nothing is safe, not even crossing the road. So it's a degree of measurement. What do we mean by safe? And if safe means you can choose your own stocks and shares, you go on the market and you buy some stocks you've never heard of, I would say that's about the same as running around with gelignite tied around your waist across the middle of Martin Place. It's dangerous. People lose a lot of money picking their own small cap stocks. Fund managers can do it because there's an army of people. So the share market is never safe. But a diversified portfolio of equities in the long run has always done well.
Yeah.
And it's the best performing asset over the last sort of 20 years, 30 years, 50 years, 100 years, etc. So it's the way to go for growth, but only equities, of course, puts you hostage to those market downturns like the GFC and like the one we've just experienced. So balance is everything.
I suppose, you know, again, I mean, we don't get paid for our investments without taking risk. Even cash is a risk of inflation. So, you know, you're not going to be receiving 5% per annum with the 3.5% of inflation and then netting out at 1.5% without putting that risk on the table. You know, at the upper end, you know, in different investments, you know, you're taking a higher risk for a higher return. But it comes back to, I suppose, our point about balance and bringing all of those different asset classes, whether it be property, whether it be share market, bring them together into a sensible portfolio that's going to weather volatility.
Yes.
Because if it's not going to weather volatility, you're going to be sold out at the bottom of the market, you know, because you've taken a massive tilt into gold or massive tilt into cash or Aussie equities. So,
but if one was getting close to retirement and you'd had a really good run in your portfolio and the markets were hot like they were in 86, 7, then when things are good and you say to your advisor, shall we de-risk? Then you might sell some of those riskier assets and make it safe so that no matter what, you're fine. So if I was really wealthy, I wouldn't need to make any money at all. Earning zero return after tax and inflation is all I need because I've got so much I can't spend it, I've got enough for the kids. I'm not in that position, therefore I have some growth assets too. So it's all about how much you've got. And that's why very wealthy people are more after capital protection than growth assets. Say more modest and starting out people have to start somewhere and grow their assets, hopefully over a lifetime of 40, 60 years.
You know, we're talking about balance, we're talking about the share market, risk. You know, when I go to my advisor, I mean, my financial planner, what should I be talking to my planner about in respect to risk? You know,
well, the way I do it myself, and I actually do this every day, and often through crises, I start watching TV at 3 o'clock in the morning, so I've got all of the news, and then I have my risk models I calculate all day. It's a huge complicated exercise for me, but I am effective as an advisor. So what you need to be doing is the equivalent of that with your advisor. You're asking questions like, what could happen in the next year or two? And the answer should be, I don't know. Because nobody can be certain. But over the longer run, things will average out to such and such. But let's role play. Let's assume there's another stock market crash in 2012, in 2013. You lose half your money there. What are you going to do? So you could have a plan that says, before all of this happened, the market had been flat for a year and a half-ish, bouncing between 4,500 and 5,000. You could say, it doesn't seem to be going anywhere. I'm retiring. I'd like a bit more in cash now and go into it. So that could be a conversation because you could say it's flat, but what if it goes down 20%? And that's what happened.
And again, I mean, it all comes back to the individual circumstances and, you know, whether they're a person retiring in the next 1 to 2 years or whether, again, they're in their real growth phase of building their wealth. You know, we've talked about it before in regards to time, balance, planning to have a plan as well, and really seeing your financial planner.
And just to give a personal example again, in the recent fall in the market, I use that to my advantage because I believe as an advisor, I'm also a human who invests, I'm also a dad, that I had a little bit of cash spur because the market was a little bit volatile, and when the market fell, I bought a little bit too soon, but I put that cash back into the market because I knew what I was doing. And having that opportunity the flexibility to move is important. You don't want to say, I know what's happening, I've allowed for everything that's going on. You can't allow for everything, therefore you need flexibility and planning in your approach.
So that finishes our third edition of Portfolio Focus. Thanks, Ron, that was great. We talked about in this session about people investing and having diversified portfolios, which is, I think, is incredibly important. I use the sporting analogy. I mean, your portfolio is a bit like a sports team, you know, whether it be cricket or rugby. You know, really you have your star performers in any one year, but at the end of the day, it's your team or your investments that wins you the game. So, you know, and really chasing the top performers each year, you know, really, I mean, it just doesn't work. So we talked a little bit about the share market and investing in the share market, and the thing I'll close on is, you know, it's really important to manage your risk and plan to have a plan. You know, see your financial planner, get that plan in place. So thanks for joining us today, and I appreciate your time.